This is Simplify Multi-QIS Alternative ETF, ticker symbol QIS. In this video, we will discuss what is a QIS or Quantitative Investment Strategy, how QIS is managed, why consider adding QIS to a portfolio, and how does one implement QIS in a portfolio. First, what exactly are quantitative investment strategies? QIS strategies are model-based, rules-driven investment strategies. Strategists develop the models through extensive research, but once developed, they're traded systematically. They attempt to capture structural return premia, whose positive return drivers the strategists believe to be persistent. Simplify Multi-QIS Alternative ETF seeks to provide positive absolute returns as well as income. QIS will invest in multiple strategies across several asset classes and strategy types, developed by some of the leading quantitative research strategists at select investment banks. It will invest in 10 to 20 strategies selected to optimize risk-adjusted returns. Total return swaps are utilized as the underlying investment vehicles. Goals of the fund include maintaining volatility in the 8 to 10% range, which is roughly half of the volatility of large-cap US stocks, while maximizing risk-adjusted returns with low correlations with stocks and bonds. This makes QIS a potentially attractive portfolio diversifier. QIS is diversified across three major axes: across different third-party strategists with deep expertise with quantitative strategies, across different asset classes, and finally across strategies with different types of return drivers. QIS will invest in strategies across equities, commodities, interest rates, currencies, and credit. Within these 5 asset classes, the fund will further diversify into different strategy types, which include carry, volatility, technical, and liquidity. The fund will not necessarily invest in all 20 possible combinations, but at the minimum, it will invest in at least one QIS per asset class and one QIS per strategy type. Let's take a more detailed look at the 4 strategy types: carry, volatility, technical, and liquidity. Carry is the return from being long or short an asset, assuming spot prices remain unchanged. It can refer to a multi-leg strategy, such as borrowing a low carry asset and lending a high carry one. Most importantly, it's a totally different return driver than many traditional investments, such as stocks, which rely on changing prices in order to profit. Volatility is the market's expectation of risk, which is reflected in options prices. It is a broad category that can include strategies that capture returns if volatility rises, declines, or remains constant. Selling options for income is a common type of volatility strategy. Technical strategies seek to identify opportunities by analyzing statistical information gathered from a trading activity such as price movement and volume. It ignores fundamental indicators such as earnings and valuations. It is one of the oldest types of systematic investing strategies, originally introduced by Charles Dow in the late 1880s. Today is one of the most broadly used types of strategies in the industry. Liquidity strategies seek to identify opportunities created by anticipated market liquidity or significant buying or selling events. Examples might include buying securities in anticipation of their addition to a popular index, trading around the anticipated options row of a popular hedging strategies, or trading around anticipated flows from technical support levels. It is important to note that the 4 types of strategies are not mutually exclusive. Strategies may have elements that combine 2 or more of these types. Let's take a look at the example of one of the strategies that might be found in QIS. The strategy is within the credit asset class and the volatility strategy type. This strategy attempts to take advantage of the structural nature of options pricing in the high-yield market. The chart shows implied volatility or option pricing in bronze versus realized or actual volatility in gold for a popular high-yield ETF. As you can see, implied volatility has historically been consistently higher than realized volatility. Perhaps a reason for this is that investors are consistently paying for options to hedge their portfolios, which drives up options prices. An option selling strategy, such as selling a put and a call with the same expiration date, can capture this pricing differential. A daily hedging strategy can be added to control risk. This is but one of the type of strategies that may be found within QIS. Here's the portfolio construction process for QIS. It begins with a universe of over 2,000 available strategies from selected investment strategists. From this list, QIS filters the top 100 strategies based on risk-adjusted return. The final group of 10 to 20 strategies is selected to both ensure diversification across strategists, asset classes, and strategy types, and to maximize correlation benefits. All of this was done using extensive research and testing, as well as qualitative analysis by Simplify's portfolio management team. Why consider investing in QIS? The primary goal is to add an independent source of returns with low correlation to traditional equity and bond portfolios. As we saw in 2022, equities and bonds can sometimes be positively correlated when you need the diversification benefit the most. Adding a third leg to a portfolio, low correlation alternatives, can potentially reduce drawdowns while increasing returns. QIS is internally diversified across multiple third-party strategists, asset classes, and return drivers. Lastly, these type of investments have traditionally been available in a hedge fund form only. Unlike hedge funds, which are limited partnerships available to accredited investors, QIS is an ETF that requires no additional paperwork, can be sold at any time, has no incentive fees, and produces no K-1 tax forms. How can investors make room for QIS in their portfolios? A simple way to add QIS and other alternative investments is to add the desired allocation and then allocate the remaining positions pro rata. For example, say a portfolio begins with a 60% stocks and 40% bonds. The investors decide to add 10% to QIS. The remaining 90% will be allocated in the original 60-40 proportions, resulting in a portfolio of 10% QIS, 54% stocks, and 36% bonds. Let's do some Q&A. Where does QIS fall on the investment risk spectrum? QIS is expected to have volatility and drawdown risk somewhere between investment-grade bonds and high-yield bonds. There are many alternative investments available in the market. How should investors think about QIS's place within an alternative sleeve? Because of its diversification across strategists, asset classes, and return drivers, QIS is a reasonable choice for the first alternative investment added to a portfolio. From there, investors can further diversify into strategies they find compelling, including managed futures and equity long-short strategies. Do the total return swaps in QIS have counterparty risk? The total return swaps do involve some counterparty risk, but due to their collateralization, such exposure is minimal. What is Simplify's role in the portfolio management process? In addition to selecting the initial strategies for the portfolio, Simplify's portfolio management team will continually monitor the strategies and make changes to the strategy mix if opportunity exists to improve the portfolio. The prospectus mentions income as a goal. How will the fund generate income and what is the fund's tax treatment? In order to avoid a single large distribution at year-end, gains from the strategies will periodically be distributed to shareholders. They will be treated as ordinary income. Thanks for watching this presentation. To find out more about this or any other Simplify ETFs, please go to simplify.us. You can also book a meeting with us directly from our homepage. Just click on the Contact Us button on the main menu. We look forward to speaking with you.